Hey, it's Nolan Matthias from Mortgage360, and the Bank of Canada just dropped their overnight lending rate by 50 basis points, but that doesn't help you determine which mortgage you should select. So today we're going to give you some universal tips on how to select a mortgage in 2020, and at the very end, I'm going to tell you exactly how I would choose a mortgage for myself if I was purchasing a property or refinancing this year. But first, if you want the most honest and transparent information in the mortgage industry, do me a favor. Hit that subscribe button, hit the like button on this video, and if you're in the industry, I strongly recommend that you hit that notification bell so you are the first to know when a new video comes out. So the Bank of Canada lowered its overnight lending rate, and obviously everyone's thinking, yes, it's time to get a variable rate, right? Because obviously, variable rates are affected when the Bank of Canada lowers rates, not fixed rates. Okay, so quick sidebar here. Variable rates and lines of credit are what's affected when the Bank of Canada moves rates and subsequently when the banks actually move their prime rate. Fixed rates are usually affected by the bond market, which runs independent of the Bank of Canada and the Federal Reserve Bank, but somewhat correlates. Now, correlates isn't causal. So in other words, the rates tend to move fairly similar directions, but it doesn't necessarily mean that just because the Bank of Canada lowers rates that fixed rates are going to lower and vice versa. That's why sometimes you have variable rates that are higher than fixed rates, and sometimes you have variable rates that are lower than fixed rates. So they move together, but independently. When the Bank of Canada lowers interest rates, what we're usually talking about is variable rates and HELOCs that are affected, not your standard fixed rates. Now, that being said, fixed rates have been trending down, but that's because of what's going on in the overall economy. Squirrel. There was actually literally a squirrel there. Like when I said squirrel, there was a squirrel. I could see it out the window. Okay, so then the first question is, do we want a fixed rate or a variable rate? Well, let me give you some rules to help decide. Let's start with rule number 1. If you're purchasing a rental property or you own a rental property, you always want a variable rate, like always. The reason why you always want a variable rate is primarily payout penalties. On a variable rate, it's always going to be a 3-month interest penalty. Well, almost always, but 99% of the time, it's going to be a 3-month interest penalty. And that's the cheapest form of a penalty you can get. And the reason why you want to make sure your penalties are low when you own a rental is because if you ever have to liquidate it or sell it, you definitely want to have the ability to get out of the mortgage without having to send a whole bunch of your equity to the bank in the form of a penalty. And the other reason why is, listen, it's an investment. You can afford to be a little bit more aggressive with an investment than you would want to be on your personal residence. So no matter what you do on a rental property, you always want to have a variable rate mortgage. And that's what we do personally. Our rental properties always have variable rate mortgages. So we're not telling you to do one thing and then doing something totally different. What we're saying is that variable rates are the best options when it comes to rental properties. And 1, it's because you're more likely to save with a variable, and 2, it's because you're reducing your payout penalty risk. Rule number 2, and by the way, going forward here, most of what we're talking about is to do with a personal residence and not a rental property. But rule number 2 is always pick the mortgage with the lowest rate. So if it's a 2-year, a 3-year, a 5-year, or a variable, it doesn't matter which one you choose as long as you choose the one with the lowest rate. Variables are often going to be the lowest rate, although the last year or two they haven't necessarily been the lowest rate that you could possibly get, but most of the time the variable rates are going to be the lowest rate option. But if they aren't, choose the fixed term with the lowest rate. Right now, at the time I'm recording this, that's actually a 5-year fixed, which is an anomaly. So most of our clients are choosing 5-year fixed and getting great deals on them, some of them as low as 2.54%. Now, rule number 3 is the exception to rule number 2. And that's this. If you can get a longer term and pay less of a premium than about 0.1% for each additional year, then you should probably take the longer term. So let me break that down for you in an example. So let's say you can get a 2-year mortgage at 2.29, but you can get a 3-year mortgage at 2.39. We think you should take the 3-year mortgage because you get that extra year for only 0.1% more in interest costs. Now, same thing, let's say you can get a 2-year for 2.29 and you can get a 5-year for 2.59. We think you should take the 5-year for 2.59 because it's only costing you about 0.3% more. And that extra 0.3% per year for the added security between year 2 and year 5 and that longer duration at that low rate is worth it in our opinion. One of the things that we've always told people is if you can get a variable rate for 50 basis points better than a fixed rate, it's better to take a variable rate than it is to take a fixed rate. But if you can get a fixed rate and only pay a little bit more, so less than 0.5% more to have that fixed rate locked in for 5 years, we often encourage clients to take that mortgage as a security option. Now, a lot of this has to do with risk tolerance, so how a client will feel about having an interest rate that can vary, but these are basically the parameters. There's times where it definitely makes sense to take a variable, and there's times where it definitely makes sense to take a fixed. But when it's hard to determine between the two, that's when these rules really come into play. Rule number 4 is to stay clear of discount and no frills mortgages. Like, unless you really know what you're getting into and you have a reason for wanting to take a discount or no frills mortgage, so something that has a no refinance clause in it, or something that you can't pay out until the full term is over, make sure that you're getting a mortgage with a ton of flexibility. And mortgages are just like anything else. You get what you pay for. And when you get a really good deal, sometimes that deal is too good to be true. So unless you really know what you're getting into, avoid these no frills mortgages and discount mortgages at all costs. Quite often these mortgages are high in fees, and they'll have things like restocking fees at the end of the mortgage that end up making them not worth it anyways. In order to save 0.2, 0.3%, you end up paying extra money because you didn't realize that they were going to get you with fees or prevent you from being able to refinance into a lower rate mortgage. So rule number 5 is, if you're going to get a fixed rate mortgage, make sure it isn't with a bank. Now, that probably seems counterintuitive, but the reason why we want to make sure that you don't get a fixed rate mortgage with a bank is, quite frankly, because their penalties are too high. A penalty on a 5-year fixed with a big bank is probably 3 to 5 times higher than what it would be at a mortgage company that specializes in mortgages. So unless we absolutely have to take a 5-year fixed mortgage with a big bank, we encourage our clients to avoid them. You know, another thing to remember about penalties is that if you have a high penalty, you have less flexibility. So having a low penalty allows you to do things like refinance later on if rates do go down even further, which can end up saving a client a ton of money. So rule number 6 is to always consult a knowledgeable broker. Listen, when you get a 15-page document that's your mortgage, it can be pretty hard to decipher all the fine print. And the only way to really know what's happening in that mortgage is to either read the document yourself and fully understand exactly what's going on, so in other words, be a lawyer, or to consult a broker who understands what's actually going on in that mortgage. They'll know the lenders that have the high restocking fees and the high penalties and the little tricks that, the typical consumer wouldn't know to look for. I'll give you an example. One of the lenders in the industry charges a 3-month interest penalty on their variable rate mortgages, just like everybody else. But what they don't point out is that the interest rate that they're charging isn't what the client's actually paying, it's the bank prime rate. And what that ends up doing is it ends up artificially inflating the penalty. And it can be the difference between having a penalty that's $2,000 or $3,000 and having a penalty that's $4,000 or $5,000. So a good broker will help a client by making sure that they don't step on any landmines that are going to cost them a few $1,000s down the road. I can guarantee you that 99% of clients aren't going to pick up on that little minute difference, but a good broker, a knowledgeable broker, will know the difference and know that that's there. And they'll help you avoid it by switching you to a different lender that doesn't necessarily charge penalties in the same way. And rule number 7 for selecting your mortgage is actually not so much to do with selecting your mortgage, but what you do after you select your mortgage. We recommend that clients review their mortgage like they review their stock portfolio. Take a look at what's going on in the market on a quarterly basis, and if you see that rates have gone down, talk to your broker or bank and figure out if there's a way that you can refinance or lower your rate to save money. Sometimes it's a 10 to 15 minute call that will go nowhere, but sometimes it might be a 10 to 15 minute call that will save you thousands. It's one of the most simple things you can do in order to hack your mortgage and end up paying less over time. On top of all these rules, there's one important thing to remember, and that's you don't want your mortgage to keep you up at night. So if a variable rate strategy, even though it makes a ton of sense, isn't the right strategy for you because you're going to worry about where rates go and it's going to keep you up at night, then don't pick a variable rate mortgage, pick a fixed. But maybe pick a short-term fixed that's at a lower rate than, say, the standard 5-year fixed. And you know what? Sometimes you can get a really good deal on a 10-year fix. So if you really, really, really want security and want to know what your payments are going to be for the next 10 years, then maybe that's an option for you as well. But more than anything, we want your mortgage to not be a stressor in your life. We want it to be the thing that allows you to live in the house that you love. As for what mortgage I would choose personally, well, if I was getting a mortgage through a bank, I'd almost always choose a variable rate mortgage. If I was getting it through a monoline lender or a lender that only specializes in mortgages, I'd pick whatever the best rate is, whether it's a short-term fixed, a 5-year fixed, or a variable. It's really basic math. You pick the mortgage with the lowest rate at the time you get the mortgage. As I'm filming this video, the mortgage I would take would probably be a mortgage with a First National or a Merrick's Financial, and it would probably be in the 2.54 to 2.64% range. Would be a mortgage with great prepayment privileges, with low penalties, and with lots of flexibility for the long term. So if this video was helpful to you, do me a favor, subscribe to our channel, click the like button, and again, if you're in the industry, hit that notification bell so you get our videos before anybody else. Cheers.